What key indicators should you use to amplify capital growth from your property investment? Hi, I'm Sam Powell.
And I'm Jaryd Krause, and we're the co-hosts of the Property Powers Australia podcast. And in this episode, Sam and I talked to Luke Metcalf, who is at the top of Australia's property data world with over 3 decades experience as a data scientist. In this pod, Sam, Luke and I talk about gentrification, affluent scores, and HIP scores, the famous HIP score that Microburbs has coined, and what these data points actually are and why you need to understand these at the start of your property investing journey.
Yeah, we jump into a few really interesting questions, and one of them being what is the optimal buying window for investing in a property? And it's not how it's along as you may expect. There's actually like a really intricate way of answering that question that Luke's gone through. So it was a really interesting conversation. We also discussed the billion plus inputs of data that the AI that gathers in the Microburbs data system. It's actually quite phenomenal, and why most actually of those data points get dumped, and why it focuses on those key, 5,000 or odd data points to help you amplify your own investing returns.
Yeah, this is part one of the capital growth data metrics to use for Australian property with Luke, and obviously it's not the only way we can help you for free. In part two, we've got another episode where we're going to be talking about a bunch of different things like the median house price, how it's typically inaccurate, and how Microburbs calculates this differently and more accurately with their smart median house price. And then we move into Sam's go-to metrics that he uses on Microburbs and why he uses them as a sophisticated buyer's agent.
Luke also shares with us, how to best use the Microburbs platform. So I go through, how I utilize it as an investor and obviously a property investment advisor. But then also Luke shares, his knowledge and how to get the most out of this platform that he's created. We also jump into why most investors actually acquire the wrong asset at the wrong time in the market cycle, and how to fix that. So there's definitely a lot in there that we really hope you can get a lot out of.
Yeah, for now, let's get stuck into today's pod. Also, if you haven't got our How to Maximize Your Borrowing Capacity mini course, head to propertypals.au/resources and use this tool to help you buy a superior asset and achieve a better result.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional.
Welcome back, everybody, to another Property Pals podcast. Luke, welcome back as well.
Looking forward. Thank you very much for having me, Jaryd and Sam.
Whereabouts are you in the world at the moment, Jaryd? You look quite nice in that background there with a tree above your head.
Yeah. I woke up this morning in Cedarman. It's called Cedarman. It's north of Ubud in Bali. Like lots of rice paddies, and it's just like a sort of quaint sort of little getaway that I'm here for a couple of days, checking it out.
There's some amazing resorts there, really well-priced resorts, in Cedarman.
There is. Yeah,
super serene, not as crazy as Ubud.
You've been, Luke?
Yes, I've been a little bit. I haven't stayed overnight there.
Cool.
But I've seen beautiful waterfalls and rice terraces around there.
Yeah, it's amazing. I went to dinner last night, and it was just this incredible, like really good prices, but amazing food. I had I won't go into it, but. Yeah, welcome to the pod, Luke. Let's pick your brains while we've got the time. Last time we came on, we finished the conversation with a bunch of things that we just really didn't have time to get stuck into. Maybe let's start with gentrification. I guess we want to sort of look through the lens of how can somebody looking to invest in property in Australia search for capital growth via the data that you guys are producing through Microburbs, and how that not exactly. I mean, we don't need to go into the how of how the data is collected, but why that data is so valuable to somebody looking to invest in a property capital growth, and what sort of data points they should be using. So, should we start with gentrification, maybe?
Yeah, absolutely. So lots of people have lots of ideas on what gentrification you need. Some people say you should go on the high end. Some people say you should go on the low. These things do influence capital growth. And I've always taken the approach of I want to see the pattern in as many different markets over as long period of time. So what are the truly reliable factors as opposed to trends? So you can have times where there's a rebound at the bottom end of the market or a rebound at the top. These things go in swings and roundabouts. So my big thing is like, what are the long-term capital growth consequences of choosing a particular socioeconomic end of the market? Broadly speaking, what you want is somewhere in the middle. So you don't want a town that's going to be taken over by meth, or you've got all kinds of disadvantage. So there are kinds of towns. Public housing is a classic one. So there are kinds of suburbs and towns that are held back, and it's not time to get in with capital growth. So I've been very interested in quantifying this over a long period of time. And it's particularly if it's not going ahead. If it's going down, obviously there are times where you're starting with a low cost base and a new kind of person is moving in and the place is changing. And then as you get into the middle, there's all these kinds of things. There's a dynamism going on. People are bringing in more money. They're making profits. There's a certain kind of middle class that performs particularly well as they're going up the socioeconomic ladder to creating more wealth. And then at the top, you've got a lot of people diverting funds into other things other than real estate. There's less demand. You're getting people having other kinds of investments. They become property investments themselves. And so at the top level of gentrification, these in the microburbs parlance, the high HIP score, these kinds of places don't perform as well. There is this path that you go on, and broadly speaking, the middle is good, but it is more qualified than that. There are certain kinds of things happening in the middle that lead to this kind of growth. It's a nuanced thing, but definitely gentrification is an important one. You want to hop on during it. There is a cycle. You can be too early or too late, basically.
I'll jump in. First things first is you mentioned the HIP score. That's a bit unique to microburbs, and it's your big brain on campus that's developed that. Can you help to break that down a little bit for us?
Yeah, so it's quantifying coolness, which it got a lot of press. Like we released it back in 2016, and it got a lot of press back then. So I think it's quite funny, a geeky person like me coming in and giving you an exact number for every pocket in the country, how cool it is. So when I say cool, I don't mean what a suburban teenage girl thinks is cool. I mean in terms of trendiness. So it's a cosmopolitan, inner city, progressive kind of person. These are places where it's already at a point where it's got a lot of cachet. And so these kinds of places, you can end up having, they're very educated. These kinds of places, the world has moved on from the real estate market often into other things. An extra word to say here is also about downside risk. So as you're going more towards inner city places, because you've got very diverse economies, it's not as likely to go massively down. So we don't have, like you have in the US, where you have these rotting urban cores like Detroit or something. So we don't have that kind of thing there. And so because we're buoyed by high minimum wages and a relatively generous welfare system, we don't have, and migration patterns, so we don't have the same educated migrants. So we don't have the same downside risk associated with these places. So if you want to go for somewhere that's more like blue chip, it's not going to be terrible, but it's also, in general, but also it's not going to give you the really high-end capital growth. So if your goal is to build a portfolio of properties I wouldn't go for the blue chip. That's more like having something solid, but you're probably going to have to keep your day job.
So that
I
brings me
love that.
to the like when I talk with clients, I talk about risk and their risk tolerance, and those that listening to this, it's like, well, if you do have a low risk tolerance, then yeah, those blue chip, capital cities, that's where you're essentially parking your money. If you're looking for advanced capital growth, then focusing on these types of scores and these HIP scores, I imagine, would help you get that alpha in your returns. Is that kind of a fair way to put it?
That's right. Yeah. So the further away you get from the capital city or away from the major city, the more variability there is in outcome. So you could think of it as like stock market analogy. A small town is like a penny stock. So it could go up massively, but it could also be held back. So increasingly, as you're going further out, as you're getting to less known about stocks, it becomes much more about algorithms. So it's much more about knowing the right time to get in, and less that you can rely on that. So broadly speaking, capital cities have outperformed regional Australia, but that is a broad thing. So it's the safe option to go for a capital city. And it is an important thing to ask yourself, because we humans are very loss averse. So it is an important thing to ask yourself, like, how prepared are you for the potential for a loss? So our forecasting algorithm is very much on the side of we don't want to have a dud month. So we actually sacrifice the alpha. That means outperforming the market so that we can be a more consistent performer. So we're more like, we don't want to have 3 months of a business where on average people underperform the market. We'll do anything to prevent that. So we've factored that into our models. But yeah, even safer than following a forecasting model is just to go with something. Obviously, if there's a whole lot of jobs around, whole lot of employment. So if you're going for a capital city, it might become less appealing for some people who want to move out for peace and quiet, but there's always migrants ready to come in to replace them. So obviously, broadly speaking, in any market, you want to have a lot of different kinds of buyers. And if you've got only one or two, the worst of all is mining towns. So if there aren't mining industry people, then you're pretty screwed. So that is another point on the most reliable indicator thing, is like mining towns just underperform time and time again. Like if you're going to go mining, if you really think a mining industry is going to go up, why not just invest in the companies? You'll get more upside than going for the town anyway, because in the town it'll only be a short-term opportunity of like positive cash flow.
Yeah, that makes sense to me. I want to hog the mic this whole time, Joe, because I love this platform. I use it at the moment every day.
I was going to say that. I was going to say, look, you've jumped in and been using this platform. I'm sure you've got a bunch of points which is going to be valuable for listeners to have answers about the questions that you have based on what you've used, why you've used it, and how it works. So yeah, let's go. Like I'm just going to be a fly on the wall and listen to you guys chat and soak it all in. So bring it on.
Well, you've got a better way to ask questions than I do, mate. So yeah, correct me as I go through. But yeah, Luke, it just sounds like we're getting more into a technical analysis viewpoint with the data. And I mean, if you go down the share trading sort of background, like there's fundamental analysis and technical analysis. How have you worked in that kind of like fundamental analysis, like into the Microverbs platform with your, I guess, forecasting models? Is that helping? Like, is the HIP score sort of a big part of that? Can you just walk me through that?
Yeah, absolutely. So yeah, that's a good way of breaking it up. So the technical side of things is very much our forecasting. So the forecasting model is just interested in prices and volumes and land supply. It looks at a very large number of graphs, millions and millions of graphs, and is finding patterns in them. So that covers, it knows about 25% of what's going on. It's enough. It knows enough to consistently make money, but there's plenty of other stuff going on. So it does really matter the kind of person who wants to move into the suburb. It matters what the prospects of the suburb are. So yeah, at Microverbs, we're all about, we want to cover off everything about why you would go for one suburb versus another. So the way people talk about a suburb at dinner parties matters. The way people might talk about it at, you're meeting a neighbor at a barbecue. All of these things go into the demand, and you can't simply think of it as just pricing. So for one example is that there have been times where the model overall has been too bullish on Western Australia because it's not taking in mining data. Yeah, it's just looking at where the curves have gone. But overall, it still performs better. Like the big thing is it's performed so well over a very long period of time. So that's the benefit of the technical analysis, is that it's outperformed during the COVID, the GFC, the Asian financial crisis. So it's very resilient to change because it's all about relative prices. But there's much more going on. We microburbs, back in 2014, we really started out to paint a powerful picture about suburbs, and over time we've learned about how these things also influence capital growth. So yeah, there's the gentrification. Another thing is the natural setting. So what we found is that really beautiful, picturesque places have tended to outperform the market. So geography is something that very few people talk about, but we'll be having more to say about this soon. But that is also a powerful thing. So yeah, you've got your affluence score for your affluence score, lifestyle score, gentrification for gentrification, HIP score as well. You've got your forecasting model, and then there's all these other things. Yeah. Where would you like? What piques your interest?
Oh man, it all does. But even the level of families, like that family score, because I guess that's the when I talk with investors about where to invest, I talk a lot about owner occupier appeal, because that's the, I guess, emotional end user that you want to be selling to. So it's easy, say, to buy a property in Australia. It's a bit more challenging to sell that property, especially if you're not getting that market.
Ideally, you want to appeal to both. So that markets where people do talk about how places that have loads of investors in there perform badly, but also you don't want to buy. Here's another thing. People talk about tightly held pockets, and that is a really powerful predictor. So that's a very reliable one over time. So you want where the tenants have stuck around and the owners have stuck around. You don't want it to be diverse in that. You want them to be consistently sticking around. And then the individual home as well. So, and the individual home, if the more times it's traded, the less its subsequent capital growth. So, the ideal often is to buy a property that's been held for a long period of time and then flip it after a couple of years. So because for every extra year you hold a property, the capital growth decreases. We've seen that it's quite a universal pattern. To a degree, you might say, okay, a renovation is more likely to happen early on than later, but also it is, we've tried as much as possible to control for that, to take out any kind of renovation from the data. So looking at when they've added bedrooms, or the description now contains more stuff. So yeah, that's another angle people don't think about. Often it can be that the tightly held, if something is being traded a lot, there's something bad going on in the street, and we're providing these street level tightly hold times. Something bad is it's not showing up in the data anywhere else, but it is a sign that something's going on. Maybe you simply can go, look, I just don't touch it. I don't have time to find what's wrong with that street, but they're trading a lot, so I think I'll keep away.
And how in the data can you, I guess, look for those types of areas that have been more tightly held? Is there a certain sort of filter that you've put on with your data, or can you walk us through that?
Yeah, so we have all of the transactions. We have a property database, 90 million listings going back to 1990, and over that. So we can just see how often an individual property has sold. So we're matching them to go, okay, we know what this property is. We can see that it's been sold many times. And then we work that out. We aggregate that to a street level, because streets really do perform quite differently to one another. You have different kinds of people. So when people talk about a suburb, usually a suburb has many different markets within it. So you will have streets that perform more similarly to streets in nearby suburbs than streets in the same suburb. We go down to this street level. We can see all of the individuals. So we're not just interested, like our competitors, in what were the sales in the last period, but also how much money did different kinds of properties make. So we're much more focused on that than others. So because of we're really focused on the buyer, it's much more about like, okay, if you buy this property, how much capital growth do you expect to have, regardless of what kind of property is selling in the market at some later date.
Yeah, very detailed.
Sorry if I need to focus a bit more in my answers here.
Nah, don't be sorry. I jump around a fair bit, so things just pop into my brain. I like the free flowing nature of just a bit of a standard chit chat. But my mind was, when we were talking about gentrification, sort of going back there, and all the data that you obviously put together. Is there somewhat of a buying window in these types of locations? Like you mentioned gentrification. I see areas like there is. I've seen it happen in Jaryd, Gold Coast, where we grew up. There's a place along like Maddox Road in Burleigh, which was gentrified in the last couple of years. When we were growing up, it was a bit of a ghetto, and it was just like in my mind, I was like, well, when is that ideal time? Because sometimes it feels like, without actually looking at the data, you can drive through it and you feel like it's ripe to be picked, and some people jump in, but then they're sitting there for 4 or 5 years and they've lost that, I guess, the opportunity cost in going to a different area. So
I love this question. This is so good, because there's so many streets or pockets in Australia that people know that's going to blow up, but when is it going to blow up? That's a good question.
Yeah. So one aspect of this is like word getting around. So there starts to be a story going around that this has the ideal setting from a gentrification point of view. So that can lead to quite fast price corrections. So if people believe that it's underpriced, particularly in the buyer's agent industry, if you have BAs copying one another and investment advisors and all of that. So definitely from that point of view, you can have a price correction and you're too late. Our forecasting model does change from month to month in general. So on average, from 1 month to the next, on average, the forecast has changed. For the most recent model, it's changed 0.5%. So it is constantly adjusting, and sometimes the corrections are much more radical than that. Broadly speaking, gentrification is a slower moving thing than market timing. So the actual change in the composition of a suburb. Now, a really important point here is that the fact that different kinds of properties sell at different times. Yeah. So even if you have a new, more high-end person coming in, that still does that represent the bulk of sales? And then also those people, you've got to be really careful that if they're doing lots of renovations, that you're factoring in the cost of those renovations in the increased growth. So let's say you've got a suburb filled with shacks, and then you have all these people coming in determined to renovate. They see it as a great thing. You've got to be careful that it's not just the increase in median price is just reflecting the fact that the housing stock has improved. So our competitors don't look at this a lot, and we tend to find that there's definitely this kind of like, it's gentrification in the buildings more than in the fundamentals about the kind of people that are there and what's their attitude to money. So be very careful about gentrification there. And it can be that you can have new kinds of properties now selling that are new, and they might have higher turnover, but the if there's enough of them, that's affecting the median price, but not in a way that you can capitalize on. So yes, gentrification happens more slowly. So the metrics are more like, so the technical trading stuff is more like a 0 to 4 year time span. And then gentrification, I tend to look at it like 3 to 8 year kind of thing. And so it's not, and because of the true drivers are not nearly as well known. So people aren't all following the HIP score and the affluent score. They're doing it based on their own stories. It's not like there's this necessarily this great price correction going on. It's not like a government department releases new data about the finances of different kinds of people and then people jump on. They're not acting on those metrics. So I don't see it as much in terms of sudden price changes on the gentrification side, unless these are particularly well talked about suburbs that have got people's attention.
I would just want to dig a bit deeper into. That's awesome. Thanks, Luke. I just want to dig a bit deeper into when you mention you've got a bunch of shacks in a street or a suburb, and then people are going to go in and renovate. And you said to consider the price of the renovations.
Mm.
Does this? I was going to invest in the Gold Coast 2018, around 2018, 2019-ish. And I was looking to buy like a unit to renovate. And I realized that the units that were unrenovated were selling for the same price as the units that were renovated, roughly speaking. And the reason being is because the people that are selling them know that that's the value of people that they're going to renovate them anyway, and they're going to be able to get the same price. Is that kind of what you're saying? Is that these shacks will go up in value as other sort of properties are renovated, or should we be not acquiring those properties unrenovated for the same price as the renovated properties? Like,
the unit renovation is not something I've studied, so I can't speak to it. I can talk much more about house and land there. So you can see that. So there's a cost in knocking down a home, and I've definitely seen in markets that the 1970s perfectly livable home is worth nothing, really, even though it might show up as worth something from the land registry services. So that actual shacks, blocks of land with shacks on them, like fibro, are worth maybe even more. It's even just more convenient for them to build. But yeah, the big thing is that we're just spending way more money on houses, relative to what they're worth today. And so usually an investor is going to simply hold on to that property and maintain it. Maybe they're paying this 1% maintenance every year. So it's really about what's the outcome for that particular person, and not So the real estate industry gets to brag about these very large growths, but they're not counting the fact that so much of the value is actually depreciating. It's a depreciating asset, and it's an extra cost that people are not factoring into the purchase.
Yeah, it's a really good point. Even to pull the data out of that is quite challenging, I imagine.
Yeah, it is. So you go to CoreLogic and you get a median price for 1 year, and you get it for another year, and then you just get a ratio of the two, right? And it's true that median price serves they try to represent the whole market at each point in time, but if there's been a big change in the kind of housing stock there, it's just an unreliable growth metric. It's if there's $1 million houses put in, and what I've found from analyzing others' data is that when there is a big diversity in housing stock, then their models are or their prices are less reliable.
Is this where the smart median pricing you've got is delved into it? Because definitely in my experience, you see that the median house price, like a lot of people refer to it, it's so variable. It's like if you're looking at month to month or year to year, it depends. You might have had a large number of sales sold in, the 2 million, 3 million range or more, which brings the median up. Like, can you just talk me through what sort of the data points and how you come to develop something like the smart median?
Yeah, so the smart median is held back by when there is changes in the kinds of housing. This is what's called a hedonic measure. So you can have different kinds of homes sold at different times. So the low end of the market sells all the time. And in quiet markets, low end properties sell twice as much as high. So roughly the bottom quintile to the top. So a smart median is taking that into account. And it's also smoothed out by other things. But a challenge is that if you're coming up with any median price, like that represents anything, has to encapsulate the value over time. So even better, we have what's called a smart hold that we'll be putting out. And our forecasting model is really used on that. So that's really looking at how for properties that are held for a period of time, what is the annualized capital growth on them? So it's held back by that. So if you have, so if you have like for like the same property bought and sold, and they're not making much money, but then you're seeing the median prices going up a lot, my model just goes, I don't trust this median price thing. I think that there's newer homes on here, so we're pushing it back. So our forecasting model, even if it sees these big median prices, even in the smart median, if it sees it growing, but it's like, I just don't see that individual investors are getting in and making money out of it, then I'm not going to forecast it. I'm not going to be trained on that. It's much easier to forecast where new homes are going to be built than when land goes up in value. So that's been a big reason why it's taken so long to come up with, and so much effort to come up with a great forecasting model.
With that, I just want to, just so people listening, a lot of people they could go find the median house price on, a bunch of suburbs just on realestate.com.au. I'd love for them to know, and even for me, because I don't know, is the difference between how that median is calculated with, say, that example that I just mentioned there, versus how you sort of smooth it out. What are some of the things that you use to smooth out, the median house price range or the smart median range that you guys?
So we are looking we're looking at land supply. We're looking at renovations. We're looking at just the prices themselves. So prices just looking not right. We're looking at the diversity of prices. So if you have a big divergence in prices, so if the top quartile and the bottom quartile go in different directions, so you've got 30% of the market where it's all really, high-end new homes, and then there's a 30% that's really old, and then there's a middle 30%. So that all these things lead to less trust. It's like, this feels a lot more like we're talking about buildings here, when our focus is really what's happening to the land, because it's the land is the thing that will grow for over time. You want to buy as land that as underpriced land as possible, and then on top of that, you want a building that is good enough to give you a good yield.
Amazing. Just going to pause this episode here. It's becoming a beast of an episode. I don't want to wreck your attention span, guys. We actually going to release the next episode in a week's time, part 2, on capital growth data points that you need for buying a property in Australia. And Luke, Sam, and I, in part 2, that you don't want to miss out on, we're talking about median house prices and how it's typically inaccurate, and how microburbs calculates this differently in a more accurate way, which is their coined smart medium house price. It's fascinating to hear Luke talk about that. And then I asked Sam a question around what sort of go-to metrics and key data points he uses when using microburbs as a sophisticated buyer's agent that you should be thinking about as well when using microburbs. What else did we chat about, Sam?
Yeah, we also I stress tested as well, because obviously always learning, but getting Luke's opinion on how he believes best to use the platform for investors to go out and do it themselves. I think there's a lot of definitely invaluable information there and a lot of data that he's actually put into this. We also have a good discussion about why most investors actually acquire the wrong asset at the wrong time in the market cycle, and looking at ways in how to fix that. So there's definitely a bit into it. So I hope you enjoy part 2.